Imagine investing with the confidence of Warren Buffett, the man who turned Berkshire Hathaway into a financial powerhouse and became one of the richest people on the planet. What if you could unlock his secrets and apply them to your own investments? In this video, I'm going to break down the exact steps Warren Buffett follows when choosing investments. Not just the stocks, but how to find great businesses that will grow your wealth for the long term. Plus, stay tuned to the end because I'll be revealing one key secret from Buffett and his partner, the late great Charlie Munger, that could completely change the way you think about investing. So, if you're new to my channel, hello and welcome. This is We Have to Talk About Finance. My name is John Colley, and I'm passionate about helping you make smarter investment decisions by breaking down complex ideas into simple, actionable strategies. In today's video, we're diving into how to invest like Warren Buffett, focusing on 10 key rules, a unique scoring system to evaluate these rules, and real-world examples to help you put them into practice. And this is going to be a 3-part video series because, frankly, there's too much to put into one video. Before we start, just a quick reminder, this video is for educational purposes only, and all 3 of them, that applies to the same. It does not constitute financial advice. If you want to learn how to think about investments like Buffett, you are in the right place. So let's look at this 3 video series and how it's going to work. First, we'll go over Warren Buffett's 10 golden rules of investing, principles he has used to build one of the greatest portfolios in history. In the next video, I'll show you a simple but powerful 1 to 10 scoring system that you can apply to each rule to make better decisions and find quality investments. And then in the third video, we'll apply this system to real-world examples so you can see how to evaluate companies like Buffett would do. And make sure you stick to the end because I'll be sharing a powerful insight from Warren Buffett and Charlie Munger that's often misunderstood. Warren Buffett is known for his disciplined long-term investment approach, and I've tried to distill this philosophy into 10 rules that guide his investment decisions. The first rule is to invest in businesses and not stocks. So when he buys a stock, he thinks of it as buying a piece of the business. He doesn't trade shares speculatively. He invests in companies with strong fundamentals. He always thinks like a business owner, not a trader. An example of this is Coca-Cola, which he invested in the late 1980s. But he invested in it as a business with a global brand which is dominant in its market and a timeless product. He saw it as a long-term commitment to owning a great consumer goods company that could grow for decades, rather than simply a stock to trade. Rule number 2 is to stick to what you know, what Buffett calls his circle of competence. Never invest in a business you cannot understand. Your circle of competence is crucial, and it's better to be a master in a few areas than to spread yourself thin. If a business is too complex or outside your expertise, move on. So I've spent a lot of time working in the technology sector and I understand quite a lot about tech. But when it comes to pharmaceutical companies, I haven't got a clue and I don't invest in them because I don't understand them. For an example from Buffett, back in 1951, he invested in Geico, which was an insurance company, because he understood the simplicity of the insurance business. It had a direct consumer model which fitted perfectly within his circle of competence, and this clarity allowed him to see its long-term potential, while many stayed away from businesses because they couldn't understand them. Step 3 is to look for a durable competitive advantage. Great investments are found in companies with a sustainable moat, something that keeps competitors at bay. Literally, think about a moat, a flooded ditch that goes around a castle. This could be a strong brand, cost advantages, or regulatory protection. Businesses with wide moats can deliver long-term profits. In the 1960s, Buffett invested in American Express. At the time, it had faced a scandal which sent its stock plummeting. But he saw the powerful brand and the dominance of charge cars as a durable competitive advantage. He actually went to local restaurants and asked the owners if people were still using their American Express cards, and he was told that they were. Over the years, The moat around American Express has helped it to grow into one of the world's strongest financial brands. Rule number 4 is to prioritize financial health. Now, this is very simple. He summarizes it as rule number 1, never lose money, and rule number 2, never forget rule number 1. And this means focusing on companies with solid balance sheets, strong cash flows, and manageable debt. Healthy finances allow businesses to weather downturns and reinvest for growth. In an example, Johnson & Johnson was a company that he admired. It had very strong cash flows and a strong balance sheet. And these attributes allowed the company to innovate and acquire other businesses over the years, making it resilient in the face of market challenges. He liked that financial strength, and that's why he invested in it. Rule number 5 is be patient and hold for the long term. He said once that his favourite holding period is forever. True wealth is built over time, not by timing the market. Another way of saying in this is that what counts in investing is the time in the market, not timing the market. So once you find a great company, allow compound interest to work in your favour by holding the investment for years, if not decades. An example from Buffett in the early 1990s, he invested in Wells Fargo, the bank, when it was facing difficulties, but he saw the potential and he held on to the shares for decades as Wells Fargo grew into a financial giant. The lesson here is simple. Once you've identified a great business, patience pays off in the long run. Rule 6, price is what you pay, value is what you get. And he said this in another way. He said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that was actually a quote from Charlie Munger. Always look for value, not just a low price. The key is to buy companies that are undervalued relative to their long-term potential. So, for example, in 2016, Buffett invested in Apple, not because it was the cheapest stock, but because he saw incredible value in its brand, ecosystem, installed base, and cash-generating potential. Today, it's still one of Berkshire Hathaway's largest investments, even though Buffett has just sold off a large part of the tranche. And Apple's long-term growth justifies, or has justified, the price that he paid, proving that value outweighs price on its own. Rule number 7 is to embrace market volatility. He says, be fearful when others are greedy and greedy when all others are fearful. The stock market is often irrational in the short term. You should use volatility to your advantage by buying great companies during downturns or when they're out of favour. So, for example, in the 1970s, the Washington Post was undervalued due to short-term market concerns. He invested heavily. He believed the market had mispriced the company and he took advantage of the volatility. This investment grew substantially over the years, showing the power of embracing short-term market swings for long-term gain. Rule number 8 is to focus on strong management. I try to invest, he says, in businesses that are so wonderful that an idiot can run them, because sooner or later, one will. But great leadership matters. It's crucial that the business itself is resilient. When evaluating a company, assess the integrity, vision, and track record of its management team. The example here is the BNSF Railway, which was acquired by Berkshire Hathaway. When Berkshire acquired the railway in 2009, he emphasised the importance of the company's strong management team. The leadership had a proven track record of running the railway effectively, and that gave him confidence that it would continue to perform well under sound management. Rule number 9 is not to diversify too much. Diversification, he says, is protection simply against ignorance. I don't believe, he says, in owning dozens of stocks just to spread risk. Concentrating your portfolio on a few high-quality investments can generate higher returns as long as you've done your research and understand the businesses thoroughly. So, for example, with Coca-Cola and American Express, he concentrated large portions of Berkshire Hathaway's portfolio in these investments. This conviction-based investing led to significant gains over the years, proving that focusing on high-quality companies can be more rewarding than over-diversifying. The opposite of that is, and this is still a lesson from Warren Buffett, he says that if you know nothing about companies, then buy the market. So effectively buy an ETF or an index fund that covers the whole of the S&P 500. So you actually own shares or an interest in all 500 companies. You don't have to make an investment decision about individual stocks. Rule 10 is to invest with a margin of safety. Always leave room for error by ensuring there's a margin of safety in your investments. This means by buying at a price below the intrinsic value of a company, allowing for unforeseen risks. It's your buffer against mistakes or unforeseen changes in the business environment. This, of course, means you need to learn, and we won't cover this in this video, how to calculate the intrinsic value of a company, but the principle is what's important. So looking at Bank of America again, during the 2011 European debt crisis, Buffett invested $5 billion in Bank of America, recognizing that its stock was trading below intrinsic value. By structuring the investment with preferred stock and warrants, he ensured a margin of safety, protecting against downside risks while positioning for future gains. Now, as promised, here is a key insight that Warren Buffett and Charlie Munger derived from Benjamin Graham in his book The Intelligent Investor, the concept of Mr. Market. Think of Mr. Market as a fictional business partner who shows up every day offering to buy or sell stocks at different prices. Sometimes he's euphoric, offering sky-high prices, but other times he's overly pessimistic, offering to sell stocks at bargain prices. The important lesson here? Mr. Market's moods are irrational. He's not reflecting the true value of a business, just his emotional response to daily events, news and short-term market trends. The key takeaway from this is that watching stock prices daily can be dangerous. If you get caught up in Mr. Market's mood swings, you might make impulsive decisions, selling in panic during downturns or buying during euphoric highs. The key is to remember that stock prices don't always reflect the true value of the business in the short term. Instead of tracking prices every day, focus on the underlying business and its long-term potential. As Buffett says, the stock market is designed to transfer money from the active to the patient. So be patient and let Mr. Market's irrationality work in your favour and not against you. So if you enjoyed this video and found it valuable, don't forget to hit the like button and to subscribe to my We Have to Talk About Finance channel for more insights that will help you make smarter financial decisions. Oh, and before you go, if you want to dive deeper into my Warren Buffett strategies, now make sure you look out for the next video in this series, Investing Like Warren Buffett, the 3-step scoring system. The link will be on your screen, so click through to keep learning. I'm going to schedule the next 2 videos as premieres so that if you're watching this as it's just come out, you'll see the new video when it drops and you won't miss it. So thanks for watching, and I'll see you in the next video.